Welcome to it. Of course, this hour, the breaking news story is that the South African Reserve Bank's Monetary Policy Committee unanimously decided to change the interest rate and cut by 25 basis points, 6.5% for the repo rate, 10% then for the prime lending rate. What does this all mean for you and perhaps the sentiments around why it exactly changed? Let's unpack that a little bit now. In studio, I am joined by Kweku Kuranteng, who is from ABSA Multi-Manager Investments, and we have senior economist at Nedbank, Nikki Weimar, joining us in studio as well. Folks, thank you so much for the time. Really appreciate it. Kweku, we'll start off with you very quickly. Considering all the good news, why not 50 basis points?
I think that the Reserve Bank tends to be fairly cautious, in the approach. And so even though there were people arguing for, a 50 basis points, they can do 25 basis points as they've just done today, and then, follow it up with another 25 basis points if the data at that point in time points to inflation that's well controlled without all these upside risks.
So you perhaps see another cut this year?
The market is pricing in, further cuts, and I do see the potential for, another cut. But as the governor said, their decisions are based on data and the output of their quarterly projection models.
And we'll go to the data in just a second. But Nikki, were you surprised at all by this decision?
No, we expected 25 basis points. There's a couple of reasons for this quarterly projection model, which is almost like a vote on its own. I know they say that they are just guided by it, but in a way it is. It's like another member of the MPC committee. The output gap plays quite a significant role in their projection going forward, and we had that shocker of a first quarter GDP number. So, clearly that will impact on the interest rates going forward. And inflation has surprised on the downside, and a big force there really has been the fact that there's just absolutely no demand pressure on prices.
None whatsoever.
Just none whatsoever.
Yeah. And I want to touch then on the inflation prospects now, right? So inflation has remained within the target band as a whole since at least March 2017. It's remained near or around the midpoint since at least November last year. In that space of time, since March 2017 anyway, we've only had 2 cuts. But since November, we've had one hike and now a cut. Are we perhaps moving in a totally different direction here when it comes to the Reserve Bank? Is the Reserve Bank moving in its own way where perhaps it was intended to move another way, Nikki?
Okay, so I'm not sure what the another way is you've got in mind there.
In the sense that you've said that you need to remain within the target band of 3 to 6%. It does that, but it's not enough for us to cut.
Yeah. Okay, so the first time, so they clearly have indicated that they are really quite hawkish in their stance towards inflation.
Yeah.
So that is a clear sort of indication that they've given repeatedly. They've also repeatedly indicated that they really want inflation to be steady around 4.5%. And ultimately, if they can achieve that for an extended period of time, their hope is clearly that they would be able to anchor inflationary expectations around 4.5%. Yeah. So I think we've got quite a way to go to get society as a whole's inflationary expectations around 4.5%.
Yeah.
If you just look at the sort of wage demands the unions start out with. I know over time it moderates, but what they start out with can sometimes be outright frightening. So that is clearly their aim, and it's only been around that level at around November. So I think if they stand back, they'll say our message has been quite consistent.
Yeah.
But you can look at it from a different kind of perspective. You can say, well, this economy over a long period of time has been in the slow, unrelenting squeeze in which growth has just slowly evaporated to a point where our 5-year average growth rate is less than 1%. We shrunk in the first quarter, and perhaps there is space to give a little bit more stimulation. Especially if you do expect that the rest of the world is going to stimulate.
Yeah,
because that removes the worry about the currency to a slight degree.
Yes.
Okay, so that case can be made. I would more say that the 25 basis point last year was a shocker to me.
Yeah.
That was a surprise. Under the circumstances, we knew growth was weak. There were factors that were impacting. Oil prices had risen, but it was already falling by the time they decided.
So doesn't
to
this cut
rates.
only just reverse that mistake?
It does.
If you want to call it that?
Does.
Well,
It does.
one can say too that at that point in time, I mean, there were some expectations around, political developments at that point in time.
Yeah.
But the point that you made in the global context, I mean, from the beginning of the year, we've moved from what appeared to be a global, hiking cycle to what appears to be, a coordinated easing cycle given the growth risks and trade wars, etc.
Yeah.
So you've even seen some key emerging markets cutting rates a bit over the last couple of weeks, last couple of months, and hence it makes their case a bit stronger in this kind of environment.
And the only reason I guess I sort of ask is just in relation to the pressure that they've also received from government. That surely plays a role, Kweku. That surely, I know they'll continuously say that we'll never be forced in terms of our hand, but surely they must get a sense to say, okay, perhaps we have the leniency, we have the ability to at least release the pressure from government because all the factors are kind of easing and working in our favor here. Is this not the right time to have perhaps been a little bit more adventurous, if you can call it that?
Look, as I said, I mean, the Reserve Bank is, fairly prudent. And despite, some of the noises coming from government, I mean, I'm of the firm belief that given their prudent, approach, they're quite independent, and the governor has emphasized this, over time. So it comes as no surprise that economists who, work in the markets in corporate also had a consensus view that this was the right time to, have some form of an interest rate cut. Whether, it could have been more aggressive or not, no one knows. That would have been very helpful for, my bond.
Of course.
But I think that they want to take a measured approach, weighing the kind of risks that can emanate over time.
Yeah, you still had things like oil as well, oil expectations just for 2019 alone dropping from $69 a barrel to $67 a barrel. And that stays at $68 a barrel then in 2020 to 2021. It currently sits at around 64. Right, that's one pressure. Electricity prices clearly not doing what they thought they would do. Core expectations for CPI around 4.4% for this year, all just points to midpoint.
You desperately want this cut, don't you?
Just to decrease the house payment at the very least.
Yes, now listen, I mean, it is at this point very difficult to see that inflation is necessarily going to run away with us. But you must remember, when you're going into next year in the early part of the year, you're coming off an exceptionally low base in inflation. Remember, we had those big petrol price cuts in January up to February, and then you've got a very low base, and you've now got more pressure. Also, food prices started moving quite significantly in June. If that continues, and if you look at the food price cycle, it makes sense that it will start to increase. You're going to have quite a spike. Now, I think they said their peak was, what was it?
About just over 5%.
5.4 or 5.6, I think. Ours is 5.6, so we see it peak at 5.6. We see it peak a little bit higher than they've got it, but it is going to peak at over 5%, getting quite close to that sort of 6% level. It's a level they're not comfortable with. Now, I think under those circumstances, their argument will be to hold steady. They're not going to give you a cut unless growth drastically surprises on the downside. And from the current base, if we surprise on the downside, we might be in the ICU. It would take some doing.
A peak of around 5.4%, in the first quarter.
We're saying 5.6. Right. So they actually got a more generous inflation forecast than we have, a more subdued one. But it's still over 5%, which they will be uncomfortable with, given what's happening to food prices, and also, of course, what happens if the rate cuts globally don't materialize. The moment they materialize, you can relax a little bit, and maybe then you'll get your 25 basis points. Because then you're more assured of what happens to interest rates, what happens to the rand. And at the same time, of course, there's the big issue of Eskom, there's the big issue of fiscal risk as we get to October, when we'll get an update. And that's
boy.
big uncertainty.
Okay,
I think.
we're going to continue to talk about this, and I'm going to ask after the break where we got this 4.5% midpoint level from. And I think it's an interesting discussion to perhaps note that as well. But we'll chat about that in just a minute. Of course, as we said, the breaking news story, interest rates changing then, a cut of 25 basis points by the South African Reserve Bank's Monetary Policy Committee. 10% for that prime lending rate. We'll come back to you right after this to discuss more in detail.